Stock markets enjoyed a massive relief rally after the surprise general election win by the Conservatives. Historically, the UK stock market has done better than the US in years when the Conservatives have won power. This time looks like being no different if the jump in the FTSE 100 and the pound is anything to go by. As David Cameron went to see the Queen, shares in banks, energy companies and house builders surged. All of them could have expected tougher treatment under a Labour government. The FTSE 250 index, which tracks medium-sized companies below the top 100, did even better on the day, although the smaller company index did worse. The FTSE 250 and small cap indices have beaten the FTSE 100 over the long term. Going forward, investors judge they will continue to do well because smaller and mid-cap companies are more exposed to the UK economy than their more international FTSE 100 counterparts. And despite a recent slowdown in the economy, UK PLC is doing pretty well. Among so-called developed countries, its rate of growth is second only to the US. The joy of the city is not untrammelled, however. There are fears that the Scottish National Party's landslide victory revives the threat of a breakup of the United Kingdom. A look at how volatile the pound was during Scotland's independence referendum last year shows that's not a prospect relished by investors. Also, David Cameron's electoral success means a referendum on Britain's membership of the European Union is on the cards. Generally, business is alarmed at the idea of a Brexit from the world's largest trading bloc. But neither of these challenges are imminent. We're unlikely to get another Scottish referendum in this Parliament, and an EU vote won't take place until next year at the earliest. For now, markets appreciate the stability that a Conservative government is thought to bring. While continued public sector spending cuts by the Tories could dent economic growth, their wish to eradicate the budget deficit by 2020 means the Bank of England is likely to lift interest rates more slowly than it would under Labour. But that's enough of the UK. On a global scale, the UK election was a small story. Talking of the Bank of England is a reminder that it's central banks that have fueled a strong bull market with their extraordinarily easy money policies of the past 6 years. The big story is how the US Federal Reserve stopped its quantitative easing money printing policies last year and is set to raise interest rates from zero later this year, probably in November. The prospect of tighter monetary policy from the US as its economy slowly strengthens is one of the clouds hanging over global stock markets and emerging markets in particular. Investors have got used to a plentiful supply of cheap dollars with which to buy assets. On the other hand, the QE baton has passed to the European Central Bank and Bank of Japan, who continue to inject billions of euros and yen into the financial system. There have been signs markets have got too frothy. This month, after years of defying gravity, the price of German government bonds tumbled as data showed economic conditions in the Eurozone improving, although the Greek debt crisis had reached crisis point. Meanwhile, fears of a bubble have been stoked by the strong performances of markets such as Nasdaq, the US Technology Index, Japan and India. As a result, developed markets look expensive compared to history. Conversely, emerging markets look cheap. With the Middle East in turmoil, there is plenty of reason to be cautious. Although last year's halving in the price of oil has still to fully feed through to the countries that benefit and those that lose out. As ever, it pays to have a balanced approach and to spread your savings over a wide range of markets. Just as a guide of how you can divide your money, I'll end with a chart showing the average asset allocation of global growth investment trusts. These have around 30% each in the UK and North America, 17% in Europe, 13% in Asia Pacific, 7% in Japan and just 2% in other emerging markets. You could easily change these allocations up or down. I only chose global investment trusts because the data is easily available.